Hey guys, so we are live. Let me know if you can hear me. Let me check quickly as well. Hey guys, so we are live. Let me know if you can hear. Okay, so the topic of discussion today is about Bitcoin and Michael Saylor. So, as you can see here, um, Michael Saylor is dressed up as a warrior trying to defend Bitcoin from all the bears. There are bears like the support is broken, the regulation fear, the recession fear, ETF sell off, maybe a quantum computing hack in the future, or um, it's nothing like Bitcoin is worthless. All these kind of doubts are looming, and MicroStrategy is at a critical juncture right now, and Bitcoin is at a critical juncture right now. So, uh, I have created a short video about it yesterday, and it doesn't reflect today's prices of about 58,000 or 59,000 bottoms, but you can see here, this is the video as of price of yesterday. So let's give it a watch.
This chart shows Bitcoin's price action leading up to October 2025, when the price peaked at over $126,000. Market sentiment was wildly optimistic. The narrative was simple. The April 2024 halving cut the supply of new coins in half, and the built-in mechanics of the four-year cycle were working perfectly. Then, the reality of June 2026 set in. Bitcoin plummeted to $67,000, a massive 47% drawdown from its high. Ethereum dropped 62% from its peak, and spot trading volumes across major exchanges collapsed by nearly 40%. This creates a massive contradiction. The halving permanently reduced the daily supply of new Bitcoin to roughly 450 coins. If there is structurally less Bitcoin entering the market every day, the price shouldn't be in freefall. The four-year halving cycle hasn't disappeared, but its primary driver has changed. The actual mechanical supply shock is now heavily dwarfed by global macroeconomic liquidity. Money supply, dollar strength, and institutional exchange-traded fund flows dictate where the crypto market goes next. Right now, three specific active macroeconomic pressures are choking off that global liquidity. These external factors are effectively holding the entire digital asset market hostage. The first pressure point started with the 2026 Iran war. This conflict triggered the closure of the Strait of Hormuz, an essential waterway that handles roughly 20% of the global oil supply. Blocking that strait removed a massive amount of energy from the market, causing Brent crude oil to spike from $80 a barrel in early March to $100 by late April. That sudden energy shock bled directly into consumer prices, driving April's headline inflation up to 3.8%. With inflation running hot and sticky, the Federal Reserve lost its room to cut interest rates. Instead, the central bank was forced to maintain a tight monetary policy, holding its target rate at a hawkish 3.50 to 3.75%. High interest rates mean higher yields on safe assets like government bonds. When institutional capital can get a guaranteed return from the government, investors pull their money out of speculative investments. Because crypto is the highest beta risk asset, meaning it's the most sensitive to broader market swings, it suffers the most when global liquidity tightens. A geopolitical conflict over physical fossil fuels forced the central bank to paralyze the money supply, which mathematically drained the capital needed to sustain Bitcoin's price. The second pressure point comes from the traditional equity markets. Over $3.6 trillion in combined target valuations are hitting the public markets in 2026 through mega IPOs, led by tech giants like SpaceX, OpenAI, and Anthropic. These three companies alone are demanding over.
So let's say you are a fund manager and you are seeing all these companies which are like revolutionary and generational companies of our lifetimes, like OpenAI and Anthropic and SpaceX. So where will you park your money in? You have certain budget for high beta stocks or high beta things, and you can only afford a certain amount of risk in your portfolios. So where will you park your money? So that's why maybe fund managers are considering Bitcoin as a speculative asset, or I mean, it is kind of a speculative asset, to be honest. But um, so right now the valuations are for SpaceX, OpenAI, and Anthropic are a lot. Like they are significantly overvalued right now as of the current revenue that they are making right now. So that is why a lot of liquidity is being sucked out of the markets by these three giant soon to be IPOs. SpaceX is IPOing next week, and SpaceX is already generating some revenue from data centers. Like Google has had a partnership with SpaceX for around $1 billion a month, and likewise, OpenAI and Anthropic are also the epitome of intelligence. So, yeah, where will you park your money? That's the issue the markets are facing right now, a liquidity crisis.
OpenAI, and Anthropic. These three companies alone are demanding over $200 billion from public markets. Institutional portfolio managers have strict risk budgets. To free up the cash required to buy into these pure-play AI and aerospace companies, they have to sell off their existing high-risk assets. This visualization maps the direct symptom of that capital rotation. In a single week in June 2026, institutional investors pulled $3.4 billion directly out of spot Bitcoin ETFs to fund their transition into the new tech IPOs. This new market dynamic created a highly asymmetric correlation with the Nasdaq. Right now, Bitcoin tightly tracks major tech stock sell-offs, but completely fails to follow along when those same tech stocks rally. The massive influx of institutional capital through ETFs was the primary catalyst for the October 2025 peak. Now that capital hose has reversed direction, starving the crypto market of fresh liquidity. The third pressure point is hiding in corporate balance sheets. MicroStrategy relies on preferred stock instruments like STRC to fund its Bitcoin treasury. That stock currently pays investors an 11.9% yield, but the company's US dollar cash reserves have fallen so far they only cover about 6 months of those dividend obligations. Because they can no longer issue new equity without destroying value in a down market, MicroStrategy had to initiate its first Bitcoin sale in nearly 4 years, explicitly to pay out those preferred distributions. A similar credit risk.
So, this is another reason that Michael Saylor, he is the ultimate Bitcoin bull. He had a company called MicroStrategy, which was like a bit. Oh, this is my Robinhood portfolio, which is ranked right now just because of, but just because of sell off. But yeah, whenever in doubt, zoom out. So yeah, it's been kind of volatile, but I have gotten decent gains. So let's see Bitcoin chart. And also we look at STRC chart, which is pretty important. So yeah, this is a giant candle in Bitcoin today. In this week, it closed around at 60,847, like in the market hours. So a little bit of recovery from 58,700 or 800 kind of lows. And let's also see STRC. So this thing pays investors a dividend, and this thing is pretty volatile right now. you can see like it is supposed to be $100 almost every time, but you see these candles where the bottom is here around 90. Today also it touched 90. So you get this 10% upside right now if you get it for 90 bucks, and it is supposed to be 100. Whenever it goes above 100 he dilutes, uh, and here, so yeah, it's a pretty ugly chart right now for Bitcoin and for ETH as well. Yup, it was trading around 4900 sometime this year. Oh, it was here in August 11th, and after that it has crashed terribly. Hmm, let's continue the video.
Risk exists across the Bitcoin mining industry. To survive the margin crush of the halving, miners adopted the mullet data center strategy. They sign stable, high-margin AI computing contract in the front and use interruptible Bitcoin mining in the back to monetize their spare power. The issue is the capital required to build out AI infrastructure. Transitioning a mining facility to handle AI workloads costs between $8 and $15 million per megawatt. To afford this, miners are taking on billions of dollars in convertible debt and senior notes. These companies are making massive bets on the assumption that AI computing demand will remain permanently high. If hyperscaler demand slows down and the AI infrastructure build-out cools off, these highly leveraged mining operators will not generate the revenue needed to service their new debt. This creates a dangerous credit situation. If corporate treasuries and over-leveraged miners run out of cash, they become forced sellers. A coordinated liquidation event from these institutions dumping their Bitcoin is a far heavier tail risk than any retail panic. The 4-year cycle continues to dictate the broad rhythm of the market, but its timeline now aligns almost perfectly with the ebb and flow of central bank easing. Based on historical peak-to-trough drawdowns and the aggregate cost basis of current holders on the blockchain, the data points to a market bottom materializing around the fourth quarter of 2026. There is a dense cluster of technical support forming right in the $50,000 to $55,000 range. That zone represents the average price where the majority of all Bitcoin was last transacted, creating a heavy psychological floor for investors. Rather than watching sentiment on crypto social media, the real indicators to follow are macroeconomic. The path to recovery depends entirely on the Juneteenth CPI inflation print and the upcoming interest rate projections from Kevin Warsh, the new Federal Reserve Chair. The macro data suggests the winter is far from over. So, are you actively dollar cost averaging at these levels, or are you holding your cash to see if we hit that $55,000 bottom? Let me know in the comments.
Yeah, so also let's compare the chart of Bitcoin versus CleanSpark, which is a Bitcoin miner which has pivoted from Bitcoin mining. Um, let's see if we can add here. CleanSpark is right now around its highs for the year, so it has diverged away from Bitcoin despite being dependent on Bitcoin and a Bitcoin miner. Cool, yeah, so that's it for me. That were my 2 cents about crypto liquidations and Bitcoin. So uh, I have dollar cost averaged Ethereum and BMNR for a bit, and I am not caring too much about crypto right now. I have pivoted my funds to AI data centers and artificial intelligence stocks. So yeah, I'm uh, not gonna worry about Bitcoin too much as of now. So yeah, that's it for me, guys.